Hello and welcome to BQ Prime. You're joining us on this special broadcast where we are discussing SBFC Finance's IPO upcoming in this week. We have with us the management of the company, Mr. Aseem, Dhru, the MD and CEO, and of course, Mr. Mahesh, Dayani, the Chief Business Officer of the company. Sir, I want to first put out some facts about the IPO and then I'll come to you with my first question. The IPO is opening on the 3rd of August and closed on the 7th. The price band is set about 54 to 57. It's a 1,025 crore IPO with 600 odd crore of fresh issuances and 425 crore in offer for sale. I think the first question I wanted to ask is this change in the amount that happened from last year to this year. SBFC Holdings, which was supposed to participate in the OFS, is not participating anymore, is what I understand, sir.
So the
if anyone you can answer.
So the initial issue was at 1,600 crores, and later it was decided to break it up into two pieces. One is what we would do and a private placement, which is a secondary before the IPO, and one is what we'll take to the IPO. So what we have ultimately ended up doing is that about 425 crores is what we have done as a secondary, where the investors have sold to new investors before the IPO. In a sense, it also helped us discover the price. And and the rest is going into the IPO. So if you actually add up the two, you would see that we have done a 150 crores of pre-IPO in the company. So if you do a 1,025 crore IPO plus a 150 crore pre-IPO plus 425 crores, we have achieved that 1,600 crores that we had set out to achieve.
Okay, fair enough. One of the purposes of this IPO that you've listed in your RHP is boosting the capital adequacy of the company. Now, when I looked at the numbers, it's already about 32%. I'm just curious to understand what is the growth plan looking like for. I know you can't give too many forward-looking statements, but what is this growth plan looking like with this fundraise?
So, over the past 2-3 years, if you really look at, most of the distributions come through in the last couple of years. And, as we tend to sweat our distribution, the growth numbers tend to unfold. Obviously we're coming off from a low base, so our growth numbers are upwards of 40-odd%. But even if you were to look at the market in the segment that we're playing, that's, compounding at almost 24-25%, which means that the market's doubling every 3 years. Keeping the overall market, construct in place, we feel that, it's the right time for us to raise capital. So currently our adequacy would be closer to 31-odd%. Post the issue, it's going to be closer to 41%. So we're reasonably prepared for the next 3-4 years to accommodate the growth that would come into this.
Okay, I guess the question was also with respect to your last acquisition was 2017. After that, you've not really done any inorganic growth. So that's where the question was coming from. I understand if you don't want to answer that.
No. I think one slight correction. That was a slump sale, not
Right.
termed as an acquisition. A slump sale where you get the distribution along with it. Probably the last 5 years, we've been on a slow burn, gradually building the entire distribution. So we were slightly skewed on the south, which was contributing almost 45-50%. That's now come down to almost 38-odd%. So the intent is to actually go deeper, spread a lot more across the geographies where you present, solve for a lot of concentration risk as you move on. So that's been the.
Okay, fair enough. Coming to your book now, it's largely split between MSME, secured MSME, and gold, right? I'm people who are in this MSME business, typically NBFCs that lend to this specific segment, tend to go after the unsecured bit also quite aggressively. It's a higher yield business. Yes, sure, there's a risk of accumulating bad loans in your book, but by and large, the yield sort of takes care of it. I'm curious to understand why the secured is your focus area. And gold loans, you said you were concentrated in the south, so maybe that's where it's coming from. But why gold loans and secured MSME specifically?
So you see, MSME has been something that has been hanging as an opportunity over a long period of time in the banking circles, but it is a very hard problem to solve. And people, therefore, in this country, we don't really have, until we started, and that's the reason we started out. There is no NBFC that is pan-India focused on solving the MSME equation. So it is a tough business to be in. It's a tough problem to solve. but that's what we are after. Now you can approach this in several ways. You can approach it from an yield perspective and go after an unsecured pattern, or you can approach it from a long-term book building perspective, in which case you approach it on the secured side. So we have chosen to approach it from the secured side, especially given the fact that we are still a new company. We are still learning our credit models. We are still training our credit models. We are still training our credit officers. We have to watch our portfolio over a period of time in terms of how it evolves. So we'll have to give it a little bit of time. At some stage, we may look at getting into unsecured, but first we need to get this one model right and perfect it before and scale it before we get into something else.
Okay. Your total advances are about 4,400 crore, and you've got an assets under management base of about 4,940. I wanted to get this gap between the advances and the assets under management. What is it comprised of?
So, our overall advances, we also do co-origination. So under co-origination, 20% gets parked with us and 80% gets parked with the co-originating partner. The total assets under management under co-origination is 600 odd crores, out of which 120 crores is parked with us. That 480, 500 crores is parked with the co-originating partner. So the 480, 500 crore difference that you see between advances and the AUM is the co-originating balance, which is.
I understand. Okay. Speaking about this co-origination, now this is, in the grand scheme of this, relatively a newer, idea that they're allowed only a few years ago. I'm curious to understand the experience of an NBFC and how you see this growing, because yes, there is a risk element that you're taking on your book, so you have skin in the game. But in terms of actually owning the asset, does the co-origination model become a little skewed towards the bank or the larger NBFC that you're working with?
No, so if you look at us, look at a co-origination, and we're referring to the first circular that came out, which means that both the organizations underwrite an asset at the same time and have the dispersal split between 2018. It's fairly complex because obviously you are underwriting, then splitting the entire EMI, collecting the EMI, splitting it, and again the respective organizations account for it. So it took us a couple of years because obviously you're originating across the country. Right. But once you're reasonably set, so if you probably look at our numbers, 23 was a year where a lot of those systems and processes were a lot more stable and mature. And that's where the growth came in. The other part is that the risk is on a pari passu basis. So no FLGs and everything. Risk is on a pari passu basis. And the ROEs are a lot more accretive on it. So if you look at our dispersal patterns, we are in the range of 20-21% of our dispersals under co-origination. Second is that on an AUM, it translates to 15%, and we are fairly comfortable at the current run rate that we are.
Normally, Vishwanath, you would have seen that NBFCs usually securitize about 20-25% of their book post-origination. But we personally think that co-origination is a smarter model, where one, you get the advantage of the other bank also, which is a lot more experienced than you are. Also looking at a proposal on a transaction basis. So you get their credit assessment also into the transaction, as well as, evolve at a credit light, at an asset light, ROE happy model. So for us, co-origination has proven to be a good bet.
Okay. Coming to the risk side of the story, now asset quality wise, you're pretty strong. Gross NPA about 2.43, net NPA is about 1.1. I just wanted to get a sense from you on the provision coverage ratio. That's about 42%. That's relatively lower than what most other NBFCs are doing. Is there a reason behind that provisioning strategy?
No, so I think first we'll probably try and address the coverage ratio. So if you probably look at the pattern, the coverage ratios have moved up from 38%, 40 and 42% for last year. If you look at probably the coverage, the specific NPA coverages, on a secured book, we are fairly comfortable, and that's what the market is. The moment you try to lean on unsecured, there is a need of providing a significantly higher. And that's where the difference is. But on the secured side, I guess we are fairly comfortable at the percentages that we are.
Okay, so fair enough. A slightly offbeat question. The MSME lending, and Mr. Dhru pointed out that it's a difficult business to crack, and I wanted to get your sense as people who are building in this segment. Is this a morality-led business, or is this a financial result-led business? Because every time somebody talks about MSME, everybody talks about supporting the small business owner in India. But is that the best way to go, to focus on the moral aspect of lending to the segment?
So see, the reality is that we are a nation of shopkeepers and small businesses. So we have over 64 million businesses, in which is a record in the world in terms of the number of business units. Also, what has happened is that given that we have low purchasing power, effectively what has happened is that as a country we've evolved where every neighborhood is a full market. So you will have a grocery store, you will have a chemist shop, you will have a garage, a salon. You will have small businesses all across, and people consume. So we are the only country where people go to buy their groceries once in 2 days. Usually, you will see across the world it's once a week or once a month is what people make a trip to the mall. Here it's once in 2 days, which means that our purchasing power is small. So when this happens, the MSME units and the small businesses also have a problem that we are fine with we are a sachet economy. We're not a bottle economy. So people
Right.
buy things in sachets. So we'll also have to construct products for them, and that has been our approach, that we construct products for them where the EMIs are sachet sized. They are not bottle sized, and therefore it matches with the small cash flows that they also get. So I think the fact is that and no business is viable just on a social purpose. There has to be an underlying commerce behind it, and commerce is viable, and doing good and being fair is also viable. When you get all these things and put them into it together, and do the right thing, offer the right product, find the right customer to get the right product to, offer it at the right pricing, and offer it at fair, transparent terms. So that's how you create a win-win in the environment.
Okay. I want to close this chat off with the question on the pricing that you've gone ahead with. The band is about 454 to 57. I was looking at where your selling shareholder had acquired the shares at about 19.8, I think 20 rupees per share, right? So it's giving them that sort of a return when they're selling in the office. But I'm just curious to understand, is this 54 to 57, in your opinion, adequately pricing the company? Is the pricing the right kind of pricing for you?
So see, the pricing is something with that even the best in the stock market sometimes struggle to arrive at. So what we did was that we actually put out a significant portion in a secondary sale before going in for the issue. That in a sense helped us discover the pricing, because it was 425 crores of secondary and 150 crores of primary that we did, and that is at the current pricing in the current price band that we are talking of. So there are actual transactions that institutions have done at these levels. And what one does is one benchmarks peers in terms of where they are versus where you are on price to book, on price to earnings. So we believe that we have, to the best of our ability, tried and be fair to the incoming investors as much as to the outgoing investors. Because as management, our job is to make the selling shareholder happy, but make him regret a year later.
Okay, Mr. Dhru and Mr. Dayani, thank you so much for joining us on this conversation. Pleasure talking to you, sir.
Thank you.
Thank you.